Welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio and hammer out the weakness in the market. I'm your lead analyst. Today, we are putting OPAL Fuels directly under the microscope. Their latest earnings report just hit the wire, and it is sending some of the most confusing signals we have seen all quarter. It's a real head-scratcher, because on one hand, you've got this compelling story of growth, of expansion, of building something big, but on the other hand, the hard numbers are flashing some very serious warning signs. Our job here is to cut right through that noise. We're going to analyze the structural integrity of this company and figure out once and for all if it's truly built to last or if it's just a financial trap waiting to spring on unsuspecting investors. Let's get to work. And that right there is the whole ballgame, isn't it? I'm your market skeptic, and this is the one question that should be keeping every single investor up at night. Think about this for a second. The company posts an earnings per share number that misses Wall Street's target by a jaw-dropping 94%. I mean, that's not just a miss, that is a catastrophic failure. In any rational market, a stock gets absolutely punished for that. It gets annihilated. But Opal stock? It actually went up. So what gives? What is going on here? Is the market seeing some kind of hidden strength that the headline numbers are masking? Or is this just pure irrational hype propping up what is actually a fundamentally weak structure? My job today is to ask the tough questions and to figure out if this is a solid, forged investment or if it's just a really good story. Let's find out. To figure that out, we need a solid plan. We're going to break this down the Iron Financial way, with structure, with discipline, no nonsense. First, we're going to tackle that earnings paradox head-on. Then we will forge the bull case. We'll look at their top-line revenue, the shiny part of the story. After that, though, we're going to go searching for cracks in the foundation. We'll be looking at profitability, the balance sheet, all the stuff they hope you'll ignore. From there, we'll assess the heavy lifting ahead and weigh management's promises against their pretty dismal track record. And finally, of course, we will deliver the iron verdict. Let's dive in. Okay, so let's start with this paradox, this central mystery. A 94% earnings miss, it's not just a bad quarter. That's the key. When you really start to dig in, you realize this isn't some one-time accident. It's not a fluke. It is actually just the latest chapter in a long, long story of failing to deliver on their promises. This is all about a pattern of unmet promises. And that is where any serious analysis has to begin. Anytime a company consistently tells you one thing and then delivers something completely different, the alarm bells in your head shouldn't just be ringing, they should be absolutely screaming. Now, what is so damning about this slide is the consistency of the failure. Just look at this table. This is not one bad quarter. This is a full year of getting it spectacularly wrong. Let's walk through it. Q1, they missed by 105%, actually losing money when they were expected to make a nice profit. Q2, an 87% miss. Q3, another 75% miss. And then they capped off the year with this spectacular 94% failure. When a management team cannot forecast its own profitability this badly, quarter after quarter after quarter, it raises some really serious questions. Do they not understand their own business? Are their costs just spiraling completely out of control? Or are they just selling a narrative to Wall Street that they have absolutely zero ability to execute on? This track record, it just shatters their credibility. Exactly. The track record is frankly abysmal. But this is where the paradox really solidifies and becomes so confusing. As the skeptic just pointed out, the bottom line was a complete disaster. And not just for the quarter, but for the entire year. Their adjusted EBITDA was completely flat year over year. Think about that. They generated zero new profit growth, and yet the stock ticked up. So why? It's because the market, for now at least, has chosen to completely ignore the crumbling foundation and instead just stare at the shiny steel frame they're putting up. And that frame is the top-line revenue, which, to be fair, actually beat analyst estimates. This is the classic battleground for a stock like this, the story of growth versus the cold, hard reality of profitability. So let's give the bulls their due. Let's examine the case for strength and see exactly what the market is getting so excited about. All right, Section 2, Forging the Top Line. Look, if you're bullish on Opal, this is your entire argument, right here. You are betting that this company is successfully constructing the steel frame of a massive industry-leading business. You're willing to overlook the messy groundwork, all the costs, the debt, the lack of profit, because you believe that the sheer scale of the revenue growth will eventually, somehow, solve all those other problems. So, let's do it. Let's build that case, piece by piece, just as a bull would see it. So the bull case, it starts right here, with this one big number, nearly $100 million in revenue just for the fourth quarter. Now, in isolation, that's a solid number. It shows a significant amount of business activity. This is the first pillar of the whole bull thesis. It proves that they can generate sales and that there's a real, tangible demand for what they're selling. This is the anchor point for the entire growth story. But it's not just about that absolute number. What's crucial here is that they beat Wall Street's expectations, and the market loves a surprise to the upside. On the revenue front, OPAL delivered one. You have to understand, when a company outperforms what the so-called experts are expecting, it creates momentum. It suggests that analysts may have actually underestimated the company's growth trajectory, and it forces them to go back and reevaluate their models. This is exactly the kind of stuff that feeds a bullish narrative and gets people excited. And just look at the raw numbers here. This makes it really clear. The analysts on Wall Street were looking for around at $93.5 million. OPAL came in at nearly $100 million. Now that's not a small beat, it's not a rounding error. It's a significant outperformance of over $6 million. This visual tells you that despite all their problems on the bottom line, their sales and marketing engine seems to be firing on all cylinders. They are closing deals and they're delivering their product. This is precisely what gets growth investors to open up their wallets. Now we add another layer of strength to the argument that $99.8 million wasn't just a beat against estimates, it represents a 25% increase compared to the very same quarter last year. This is a powerful metric. It shows that the revenue beat isn't some kind of fluke or just the result of lowered expectations. No, this is genuine, hard and fast business growth. The company is selling significantly more today than it was just a year ago. This, by definition, is a growth company, and it's the absolute core of the bull argument. And that Q4 strength, it wasn't an anomaly. When we zoom out and look at the full year, the picture of operational growth becomes even clearer, even more compelling. Full-year revenue was up 16%. That's solid. But look underneath that number. Look at the operations. Renewable natural gas production, which is their core business, was up a massive 29%, and the gallons delivered at their fuel stations were up 8%. This is the key takeaway for the bulls. The revenue growth is being driven by real, physical world operational expansion. This isn't just financial engineering. It's the engine of the business actually getting bigger and stronger. And here's the final piece of the bull case, the cherry on top. They have secured the capital to keep building. Just before the earnings announcement, they closed a brand new $180 million financing deal. Now, the bulls will frame this as a major vote of confidence from the financial markets. They'll say, see, management isn't just sitting on their hands, they are actively securing the fuel needed to fund future construction and development. This tells the market that the growth story we just saw is not over. In fact, they're just getting started. From this perspective, they're shoring up the foundation to build that steel frame even higher. All right, hold on. Shoring up the foundation? That has to be the most generous way to put it. I think a more accurate description might be patching massive, gaping holes in a crumbling basement. Look, that was a great story about the steel frame, the revenue, the growth. It's shiny, it's impressive to look at, and it is exactly what they want you to focus on. But here at Iron Financial, we know that a skyscraper is only as strong as what it's built on. So now, it's time to ignore the shiny frame, take the elevator down to the basement, and start searching for the fault lines. It's time to look at the cracks in this foundation.
And we have to start right back here, because no amount of flashy revenue growth can distract from this ugly picture. The estimate was 36 cents a share in profit. They delivered 2 cents. This isn't a crack, this is a chasm. It represents a fundamental failure to turn all those sales into actual real profit for the people who own the company, the shareholders. For all of that impressive 25% year-over-year revenue growth, profitability it essentially evaporated into thin air. A company's primary purpose is to generate earnings. And on that front, this quarter was a complete and utter failure, period.
And right here, this slide lays the whole problem bare. For the full year, they brought in an extra $49 million in revenue. That's the growth story you just heard. But now, look at the right side of the slide. Their adjusted EBITDA, a key measure of profitability, went up by a measly $200,000. Let that sink in. They grew sales by 16%, but their profit growth was basically zero. So where did all that money go? Where did the $49 million disappear? This points to severe structural problems. Either their costs are soaring, their operating expenses are totally out of control, or both. This is the definition of unprofitable growth. It's like running faster and faster on a treadmill. You're putting in a lot of motion, you look really busy, but you're not going anywhere. And that shocking lack of profit makes this next number absolutely terrifying. A price-to-earnings ratio of over 106. What that means is that investors are currently willing to pay over $100 for every single dollar of this company's annual earnings. A PE that high is supposed to be reserved for companies with explosive, guaranteed, high-margin growth on the horizon. But as we just saw, OPAL's profit growth is zero. It's flat. This valuation is completely, utterly disconnected from financial reality. The stock is priced for perfection, but the company's actual performance has been anything but. This is a massive structural vulnerability just waiting to snap. But this is the number that exposes the deepest, most dangerous crack in the foundation. A debt-to-equity ratio of 32.18. Let me put that in perspective for you. In the world of finance, a ratio over 2 is generally considered risky. OPAL is at 32. This is an absolutely crushing weight of debt sitting on this company's support beams. This level of leverage is a ticking time bomb. It leaves zero room for error. If there's an economic downturn, if there's a spike in interest rates, or if there's any kind of operational misstep, this debt load could become completely unmanageable and threaten the entire structure. That $180 million in new financing? It doesn't look like growth capital anymore, does it? It looks more like a desperate measure just to service this existing mountain of debt. And hey, don't just take our word for it. Look at the consensus from the professional analysts who cover this stock for a living. The rating is reduce. That's Wall Street's polite way of saying sell this thing or get out now. 4 of the analysts who cover it rated a hold, and 2 rated a sell. Not a single one is telling their clients to buy this stock. When the people whose entire job it is to analyze this company are all sounding the alarm, that is a signal you simply cannot afford to ignore. The bear case isn't some fringe opinion. It's the mainstream professional view on the street. Okay. The bear case is powerful. It's hard to argue with those numbers. The debt is a major structural flaw, and the unprofitability is undeniable. So the entire investment thesis from here on out hinges on the future. The company has to do some incredibly heavy lifting to fix these deep-seated problems. This next section is all about weighing their blueprint for a turnaround against the very, very poor performance we've just documented. The core question is simple. Can they actually pull it off? So let's just put it all on the table. This is the blueprint. This is the battle between the frame and the foundation, all in one slide. The bull case, the frame, it rests entirely on growth. A nice revenue beat, strong year-over-year production numbers, and that new financing to keep building. The bulls can even point to the fact that EPS of 2 cents is, technically, an improvement over the 5-cent loss from last year. But the bear case, the foundation, is just riddled with weaknesses. The massive EPS miss, the stagnant EBITDA, that terrifying debt load, the insane valuation, and a clear reduced rating from analysts. Looking at this side by side, that foundation looks like it's made of sand. So here is management's 3-step plan to fix it. This is their guidance, their promise for 2026. First, they're going to deploy that new capital. Second, they're going to grow production to their new target range. And third, and this is the most critical part, they are projecting a huge jump in EBITDA up to $110 million. And they're saying it's going to be largely driven by new clean energy tax credits, specifically the 45Z credits, which benefit renewable fuel producers. But is any of this credible? I have to ask, given that they've missed their own earnings targets by an average of 90% for an entire year, why on earth should anyone believe this forecast? It's just another big promise from a management team with a terrible track record of keeping them. It is a very heavy lift, and they haven't even proven they can get the weight off the ground yet. Which brings us, finally, to our final section, the iron financial verdict. We have laid out the bull case, that shiny steel frame of revenue. We have stress-tested the bear case, the cracked foundation of profitability and debt. And we've weighed their plan for the heavy lifting that lies ahead. All the evidence has now been presented. It is time to answer the question we started with. Is OPAL Fuels a solid growth opportunity, or is it a carefully disguised structural trap? Let's synthesize this down to the core facts. The revenue growth is a legitimate positive. We can't take that away from them. It proves there is demand for their product. But that is where the good news ends. That growth is not translating into profit, which is the entire point of being in business. The new financing, yes, it buys them time, it gives them runway, but it doesn't solve the underlying profitability problem, and it just adds more complexity to an already strained balance sheet. And that debt load, that is the critical, non-negotiable weakness. It just hangs over everything this company does. And finally, their entire future rests on an ability to execute, something they have consistently and repeatedly failed to do. So our verdict is clear. OPAL Fuels is a structural trap. The beautiful, appealing steel frame of top-line revenue growth is being built on a cracked and crumbling foundation of staggering debt and non-existent profitability. The risk that's embedded in that foundation, particularly that 32-to-1 debt-to-equity ratio, far, far outweighs the potential reward from the revenue growth. The market's positive reaction to this report is a classic case of chasing a good story while willfully ignoring the terrible financials underneath. And our final thought for you is this. In any market, but especially in a volatile one, you must prioritize financial strength over a growth narrative. is solid foundation will support a company through tough times. A weak foundation will collapse under the slightest pressure, bringing the entire structure down with it. That is how you forge a stronger portfolio. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.